Hi everyone, I am Melony Swayze. I'm a residential realtor in the Metro Boston area with Unlimited Sotheby's International Realty, and I head up the Good Boston Living team. Today I am with a dear colleague, loan officer Andrew Marquis with CrossCountry Mortgage. We're going to be talking with you about the interest rate environment right now that's happening around the country and has its own flavor in the Boston area, and how that actually creates opportunity for buyers in this current moment.
Yeah, so we're talking about Boston, we're not talking federally, and Boston has always been a very much a seller's market, I would say, in the last 10 years. I mean, you being a real estate agent would be able to better comment on that, but I think we've had a situation where it's been very challenging for buyers to be able to purchase properties. There's not a lot of properties for sale in the Boston area. And I think what's different about the market right now is there's been a lot of rate hikes that we're going to talk about. And what the rate hikes have actually done is cooled the market a little bit and expanded opportunity for buyers to enter the market that maybe couldn't before.
Yeah. So there's so much talk about the Fed's rate hikes around the country and how that's impacting real estate. What we can say in the Boston area, Boston is almost like a unicorn market in that we're fairly built out. There's not enough housing for the number of people who relocate here throughout the year, every year. What we do know about Boston is that housing is in strong demand continuously. Jobs are fairly strong. We've got a very resilient jobs market in terms of the industries that people come here to work for. So that's universities, that's biopharma, for example, and tech. And I know you were talking earlier, Andrew, about being at an event where you heard that Boston right now is trending as one of the most resilient markets in the country in terms of responding to the interest rates.
Yeah, we were talking over lunch, and I recently was invited to hear a chief economist of an investment group fly in to speak with us about really the real estate market, what's happening throughout the country. And I was very pleased to hear that Boston on his radar was actually the strongest market. And what I mean by strongest market is less apt to see large price fluctuations in a downward way. And when we questioned him why is Boston unique in that capacity, he explained that it was really two things. It was mainly the inventory. And when we say inventory for you viewers, it's lack of homes, lack of supply of homes versus supply of buyers, right? There's just not enough housing to equate the buyers. There's not a match there. And so it keeps those prices high, and then rental prices are high.
Exactly.
So when there's not a lot of housing and your options are to rent or buy, it sort of puts a floor on home prices, right? And that's not to say that home prices may not, be a little bit soft here, but I think definitely less soft in this economist's opinion versus other parts of the US.
For sure. And so you could say broadly, this is still really a seller's market. Homes are selling if they're priced appropriately, if they're priced to reflect the current moment. Properties are selling very well and very quickly. And that is because housing is so hard to find. It's scarce. That's keeping rent prices high. And we expect that to continue in the coming year. So what does this mean for buyers who might want to leave the rental market and become a homeowner? Yes, interest rates are higher, but there actually might be an opportunity if what we're seeing is that housing is still limited, but there are some buyers hanging back and waiting. For those who are open to not hang back and wait, this might be a chance for you to dive in and get something done that you might not have been able to do when everyone else was flocking to buy 6 months ago, a year ago, and so on, like the last 10 years.
Yeah, and that's very reflective as to what we're seeing, Melanie. I know
Yeah.
we were talking about this very much so, where we are seeing buyers with slightly lower down payments be able to enter the market, buyers that might have a contingency to sell their home before they buy,
Yes.
buyers that might want to do a home inspection when before they had to really consider waiving that contingency, right? So we see more opportunity in the market, and we don't want opportunity to see like some flaky term, but really, I say that hindsight's 20/20, right?
Yes.
And if there's a situation where with this low inventory and rates go down in 2023 or 2024, I know we both feel strongly that could drive prices back up.
Yeah.
And so if the opportunity is to potentially purchase now at a slightly inflated rate, use one of these tools that we're going to talk about to be able to enter the market still and avoid some of that inflation in rates, and then potentially refinance if and when rates come down.
Yeah.
Right? The way I kind of look at it is if rates were 3, now they're 7 to curb inflation, rates may settle in that 5-ish range. I don't think they're going back to 3 anytime soon, but I do see them coming back down to spur up the economy as we try to exit a potential inflation.
Yeah. What we don't want is for folks to look back in the coming 6, 8, 10 months and say, darn, there was my moment in the fall or in the winter of 2023 where there were fewer buyers out and about, interest rates were higher, but that could have been my chance. And so it's just an interesting moment that we're watching.
We haven't seen it in 10 years.
We haven't seen this kind of moment. So yeah, and I think just to make clear to folks to understand that what it means to refinance, and you'll go in detail around that. Yes, interest rates are higher right now, but there are lots of mechanisms and ways to get an interest rate that's more accessible. And whatever rate you start with now, potentially be able to refinance in the coming year if and when the Fed project slows down and if in fact interest rates start to drop in the next year or two. So this is a moment to get in on the ground floor, maybe adjust and make your housing even more affordable in the coming year or two, but know that you got into a market that you might not have been able to otherwise. So Andrew, what are some of the strategies that buyers are using in this moment? Buyers who might not have been able to compete in the competitive environment that Boston has been.
Yeah.
What are some of those folks able to do now that they couldn't do before?
So I think the climate right now has become more accessible from a financing standpoint for buyers, and it's a matter of buyers having access to more loan programs. Okay, so we have down payment assistance programs. There's a Mass Dreams grant program through Mass Housing. These are generally loan programs that have very low down payments. There's FHA financing, there's renovation financing. These are a lot of programs that really were almost inaccessible over the last couple of years in the the Boston market that we're speaking about, just because if you didn't have 20% down, a lot of sellers were almost unwilling to consider your offer, which was insane. Right. So I would say definitely more financing tools and options that you could utilize in this market and still see success with an offer. But I think also in terms of avoiding the higher rates right now, a lot of clients are negotiating a seller credit in some way.
Yeah.
And the easiest way I explain the seller credit is we can put that towards the buyer to either do a permanent rate buy down, where we actually buy that rate down with a point or two, and they get a lower rate for 30 years, or we have these temporary buy down programs. The temporary buy downs or a lower interest rate for 1, 2, or 3 years that provides that buyer with a significantly lower payment for that interim beginning period of their mortgage. And the thing I really like about the temporary buy down is if they refinance out of that, any buy down funds that were received from the seller in terms of a credit actually go back to the buyer. So if they're in a 3-year buy down and they're only in that loan for a year, the remaining escrow funds for the remaining 2-year buy down cost would go back to that buyer when they refinance after a year. Okay,
yeah.
so that's
you're
really
submitting
neat.
an offer on a place and you're saying, hey seller, I'm going to give you this number, and what I really would like is for you to give me a credit toward my loan in a way that's going to drop my mortgage rate for the first 2 or 3 years. Okay. And if I then go ahead and refinance out of that very loan in the next year, because interest rates might adjust back down, if I refinance out of that loan to get a nice lower long-term rate, I still get to capture and keep the rest of that unused credit that the seller provided.
Yeah, whereas with the permanent buy down, the difference is you're paying points, let's say, to get a lower rate for 30 years. If you refinance in a year or two, the point money is gone.
Yeah,
because it was a 30-year investment.
And a point is you're paying the equivalent of
1% of the loan amount. Yep, exactly. Yep.
So are there any other loan products that you would say, or financing strategies that you would say the buyers are thinking about right now?
Yeah, I would say it's really let's avoid higher rates and let's use loan programs that we potentially couldn't utilize before.
Andrew, do you want to talk about what buyers are doing in terms of taking larger loans? It might seem counterintuitive, but taking out a jumbo or larger loan might actually give access to having a lower interest rate.
Yeah. So when we look at loan amounts, we have conforming loan amounts that are $647,000 or less. And then when a client takes a loan amount above $640,000, we call that a jumbo loan. We're in an environment right now where conforming loans tend to be in the 6 to 7% range, and jumbo loans tend to be in the 5 to 6% range. So we have situations, Melony, where a client might be having enough down payment to borrow $500,000, they might electively choose to put less down to obtain that lower interest rate on a jumbo, close on the property, then apply the additional down payment funds and recast their mortgage to a lower loan amount, rate, and payment. So by borrowing above 647, as you're alluding to, it allows clients, it's another strategy to keep that rate down. You know, and again, we can get really strategic. There's a lot of things we can do. And I think if clients right now have that opportunity to buy with a lower down payment, maybe buy at asking, sometimes even a little bit below asking, and get a seller credit.
Asking price.
Asking price of the home. These were all things that like a year ago was like a seller credit, you know, like we're not doing a seller credit, a home, you know, they were, so there's a lot more accessibility of these different options right now, which is neat. So.
And I love the idea of take a bigger loan, but you still can actually pay down that loan, but with the same funds that you have, but you just have locked in a lower rate. So there's lots of ways to play around with the numbers and the structures.
Yeah, exactly. Yeah. Is there anything that like buyers should know in the coming months as they're starting to enter the housing market? What advice would you give right now?
Well, I would say enter the housing market. I would say don't hang back and wait, because things can change so quickly, and our markets do change very quickly. So Boston isn't going to necessarily play out like what you hear in the national reporting. There's just not enough housing here. That was true well before the pandemic. That's certainly true before the current rate hikes. And so what that means is that if you can wade in now and assess your options, it's kind of a golden opportunity. So I would say reach out to your agent. Your agent can put you in touch with a really savvy loan officer to really think about what your options are and how best to capitalize on this moment, given what your cash position is, given what your assets are, given what your immediate needs are and long-term needs are, because we can actually think not just about this moment, but also about what happens in the next 6 months, 2 years, 5 years, and think about that in terms of how we structure your financing. But I would definitely say do not hang back and wait. This is an opportunity where other people are hanging back, so you go ahead and dive in and take this moment.
Have a conversation with an educated professional that's working in our unique market every day and can advise you properly on this. You know, like you said, CNN is really, they're hanging on to what's going on in some of the more volatile markets. And I think that, you know, in the 20 years in Boston, we've seen house prices go down once. We were just talking about this during lunch, and that was during the financial crisis of 2008. There was huge housing inventory, there were subprime loans. There were a lot of reasons that caused a softening in the market.
But just a softening, because even during that time, during the height of that recession, there were some markets, some neighborhoods, some towns in and around Boston that only saw prices adjust down by 5%. And what we've experienced in the last decade plus, partly because of low interest rates and people having more buying power than they've ever had, is that prices have jumped easily 50 and more %. So this is a market where if there's cash to get access to, get it and use it, because people's houses are holding value. The equity is there, it's creating wealth for folks, and it does not make sense to hang back and wait based on national headlines. Boston is its own kind of animal.